Hello everyone, hope you're doing well. Welcome back to the Road to Retiring channel. Today I would like to speak about ASML, as this is a stock I own in my portfolio and has some seriously impressive historic growth rates over the years, and I want to have a look at what the current fair value is for this and what the future price of this could be. Now when we look at what ASML is, this is a company that manufactures complex lithography systems critical to the production of microchips, and all major chip makers use their technology. They're a major player in the chip making industry, and they're actually in the news at the moment, which I want to show you here, because the Dutch have restricted advanced chip exports to China amid US pressure, and people are wondering how this is going to impact on their sales and their outlook. They've said it comes after the Netherlands agreed to a US request to impose export restrictions on China, limiting the powerful chips and deep lithography tools of Dutch company ASML. But ASML have come out and they've said that they expect fiscal year 23 outlook to remain unaffected by these new chip export controls, and also they're not expecting this to impact the financial outlook for long-term prospects as well as just 2023. So that's really nice to see, and I want to show you a bit on what those long-term prospects are, because the analysts have some seriously high estimates for this. Going into the financials and looking at the future, you can see if we look at annual and the 2023 onwards, this is going from $20.05 a share in 2023 all the way up to $40.01 a share in 2026. Super impressive growth rates, and this isn't something new. You can see currently $15.52 per share in earnings. It was $3.48 per share in 2015. This has grown by around 5 times in just 7 years. Their growth rates are super impressive, and if we look annually, it's a similar picture. Revenue up from 6.83 billion in 2015 to 23 billion in 2022, and expected to reach 44 billion in 2026. So just seriously impressive growth expected for this company. And you know, the other sort of historic metrics I like to look at are the operational cash flow, and that's also up just massively from 1.84 billion in 2016 to 8.85 billion. Lastly, I like to look at the equity, and this is where things aren't as great. You can see that equity's not really changed much, from 10.36 billion in 2016 to 9.4 billion in 2022. However, their assets are climbing every year. They're just picking up a lot of liabilities at the moment. And this did signal some alarm bells to me. I wanted to check they weren't going to be in any imminent financial trouble because of this. But if we look at their total non-current liabilities and their long-term debt, they only have 4 billion in long-term debt, and their free cash flow is sitting at 7.5 billion. So it doesn't really seem like they're going to have any sort of issue paying off that long-term debt or any sort of worry regarding that. And lastly, you know, I like to check that a company has good investment, good management decisions being made, and the return on invested capital is really nice for this company. Sort of all the numbers are great, I can't lie. There's 13.61% was 2016, and I like to have it just above that 10% level, but this was 2016, and you can see it's just been climbing since, and currently sits at 39.92% return on invested capital, which is so far above that 10% benchmark I like to see. And so I think the metrics for this company are fantastic, and if we look at the overview, you can see their debt to level to coverage is absolutely fine, 4.76 billion debt to about 15 billion in free cash flow and cash. As I say, their assets and their in long term and short term are comfortably over the liabilities, and they even have this dividend which they've been growing quite aggressively. You look, the dividend growth rate over the last 10 years is 217%, and in the last 3 years they're still growing this aggressively at 42%. Just super impressive dividend growth rates, and this is paying out around a 1% yield right now. If we look at how the value of the stock has grown historically, well, it's basically a great example of the snowball effect. You can see starts off growing, looking like slowly, and as that compound interest comes in, it's just flying up to current levels at around 600. I want to see if this is still a good value now, and put in a few estimates from what the current price could be. What I've done here is I've gone for $15.42. Now this is 2022. The reason I haven't used the 2023 estimate is because this is quite a jump from the current 2022 levels, and I want to make sure that this realistic growth rate we're using is actually based on the net income we're currently seeing, because if we were to increase this, then you can see how the realistic growth rate jumps all the way to 37%. So if we're expecting around a 23% realistic growth rate based on their net income minus their dividends over their shareholder equity and long-term debt, then I'm comfortable to go with this realistic growth rate because the analyst's 5-year estimate is around 29.8%. Now you can see I've put fourth quarter 2022 in here for the current $15.42 value. You can see in 2026 this only brings us to $37.17, whereas the analysts are expecting $40.01 in 2026. So I think that this is reasonable, and on top of this, we're using that realistic growth rate. We've put some calculations into this, still nicely below the 5-year estimate, and with this earnings growth rate, we've kept the P multiple in line with it. Now this is much lower than current levels, and you can see this is actually going to bring the fair value at $637.68, so it's actually going to be above the current price based on these estimates. Now this is super impressive considering we're using a price over earnings multiple at 23, because this is pretty much in line with just the sector median, whereas ASML's price to earnings has pretty much traded at a very high premium compared to this. You can see since 2013, this has been around 25, 23, 30, jumping up, and in the last few years 32, 39, 40, 48, all the way back down to the current day, which is 41.61. If you see here, the 5-year average for this is 37.36. So I think going with that sector median at 23 feels really comfortable, and the only thing I would be slightly worried about here is if this earnings growth rate is not met, as it is quite considerable. We could increase the margin of safety because of this, and that would then bring our buy price down to around 566. So make sure you're taking into account these things such as the high earnings growth rates. We're sort of trying to manage our risk here, but as I say, this P multiple we could easily see higher. We could easily see it around 30, and then that completely changes the fair value to $739. So I'm going to keep it around here for now. The margin of safety I'm going to keep at 10% just because the historic fundamentals of this stock are so good. I've gone for that 8.5% discount rate, 1% lower than that 9.5 we usually look for, because the dividend yield is around that 1% mark, and they do have good share dilution, -1%, but it's very consistent, and they even mention it on their website that they're committed to buying back shares, and you can see that every year they've just been buying back a little bit every single year, and they've never really faltered on this, so it's quite consistent and really nice to see. Now when we look at the price to sales fair value, again I've gone with the analyst estimate of 16% from 2023, and I've used a price to sales multiple of $6.50. Now this brings our fair value to $607.65, which is basically in line pretty much with current prices. Only needs a 1.89% drop from the current price to reach this, and I don't think a 6.5 price to sales multiple is unrealistic. If we look at how the price to sales multiple has changed, you can see it's been around 6, 7, 6.5, 7, and this was while it was low. This was when it was trading at that lower level in 2017 through to 2018. If you look over the last 5 years, this has been around 7, 10, even as high as around 15 or 14.57 in 2021. Currently it's at 11, so I think 6.5 feels reasonable for a level it could drop to, because this is where it typically was trading in those years between sort of 2015 to 2019. So with those as an estimate in here, that gives us, say, the fair value of $607. But again, the revenue growth rate, this is the analyst expectations. We could potentially see this not be met. If that was, say, only 10%, then that brings our fair value down by a massive amount. So remember, we are trusting these analysts quite a lot with these estimates. Maybe because it's quite high, again, might want to increase our margin of safety. We go for that 20%, then that's going to bring the fair value to $544. Lastly, I wanted to look at operational cash flow growth. Based on 17% operational cash flow growth from the current estimate, bringing the operational cash flow sort of just above that net income to include things like depreciation, that's going to give us operational cash flow of $19 billion in 2028. And and I've gone for a multiple of 19. Now this again is pretty much in line with the sector median sitting at 19.68, whereas ASML's 5-year average is around 33. So there's quite a good chance that it won't be this low and there'll actually be a higher premium on this. But based on these values, it would bring the fair value to $518.21. But if we were to include a premium on this at around 23, then suddenly it's currently above, the fair value is currently above the market price, and it becomes a price to buy at. But for me, I feel more comfortable at those sector median levels, just because I don't want to be too overly ambitious with my buy prices. I want to make sure I'm getting it at a good price, and so because of this, I feel comfortable, I think, with this 20% margin of safety, as these earnings growth rates are very ambitious at 23, 16 and 17%. And so leaving that at 20% margin of safety, that gives us a average fair value at around $543.29. Now, we haven't seen that too long ago. You can see it was at $540 just a few months ago. If we change this to the last 6 months, you can see at that level around $540. We've seen that as recently as December and early January, so it's definitely levels we could see again. And yeah, I think that's where I'd be interested in picking up some more shares in ASML. Right now I'm comfortable with it, and there's definitely a great outlook, and as I say, these are quite conservative. We could easily see the analyst estimate at 29% and price earnings multiple in line with that, and suddenly the fair value becomes 900, and we're going to see there's a 50% margin between the current price and fair value. So as I say, it very much depends on the estimates that you'd like to go with. For me, I feel more comfortable with the realistic growth rate and a price to earnings multiple in line with this. So based on all that information, I feel comfortable at a price average fair value of around $543.29. And yeah, let me know sort of what prices you'd like to get into ASML at, if you like the company, if you have any worries with it. And yeah, I'd love to hear your thoughts on it. This is my prediction for ASML, getting to around 1,070 if you include dividends, with 11.69% return from current prices. So definitely still a very strong hold. And yeah, that's been Road to Retiring. I hope you enjoyed the video. Bye guys.